This is the video demonstration on leases. In this video, I'm going to work the solution to example number 7. This example involves the Dalton Company. They signed an agreement to lease a machine from the Evans Company on January 1st, 2012. The terms of the agreement are as follows. Ownership remains with the lessor. The fair market value of the machine is $70,000. The estimated lifespan is 5 years. There is no purchase option. The lease term is for 3 years. The annual payment of $25,000 is due on December 31st of each year. The incremental borrowing rate is 8%. Under the requirements, number 1, we are to apply the four-way test to determine if this is a capital lease or an operating lease. Then on part 2, for the lessee, we will record the journal entry when the contract is signed. And then number 3, for the lessor, we will also record the journal entry on their side of the transaction when the lease is signed. So based upon this, we will see, is this going to be a capital lease? Is this going to be an operating lease? To do that, we're going to apply the four-way test. Now, on the four-way test, the first test is transfer of title. And the question is, does the title or the ownership actually transfer? Well, in this case, it says right off the bat, ownership remains with the lessor. So that means on the very first test, I will say no, there's no transfer of title. And then that means I will proceed to the next test. Remember, as long as we say no, we keep proceeding to the next test. If we say yes to any of these, even one of them, automatically we're going to have to capitalize the lease. So, second test, bargain purchase option. According to this, it says there is no purchase option on the lease. So there's no purchase option, let alone a bargain. So we can say no to that test. The next test is useful life. What's the useful life? It says the estimated lifespan of this asset is for 5 years. So 5 years is the total lifespan. Now remember, we talked about this in the video lecture on leases. As long as we're leasing it for less than 75% of useful life, then we're okay. So the question is, what is 75% of this useful life? Well, 5 years times 0.75 would be, in that case, 5 years times 0.75, 3.75. So as long as we're leasing it for a time period that is less than 3.75 years, we're okay. Well, we're only leasing it for 3 years. So we can say no to that test. We're okay on that. So far it looks pretty good because remember, we would actually prefer to treat this as an operating lease rather than capital. So the final test has to do with the fair value versus the present value. Now I need to calculate the present value of this lease. What's my annual payment? It says my annual payment will be $25,000. Now I'm going to have to get the present value of that. Now it says this is a 3-year lease and the percentage is 8%. So I want to use the appropriate table, which would be the present value of an annuity. This table is available in the textbook. It's also available on our class website in PDF format. But on the present value of annuity table, I want to find the 8% column, and then I want to go down to the third year. So in the 8% column, third year, 2.5771. So 25,000 times 2.5771, the present value of the lease payments is $64,427.50. Now that has to be in relation to the fair value. We want 90% of the fair value. That's the rule on our test. What's the fair value of this asset? Well, the fair value, $70,000. So that's the fair value. Now remember, test number 4 is based on 90%. So 70,000 times 0.9 is 63,000. Well, it looks like the present value of our lease payments is more than 90% of the fair value. So you know what that means. That means we've had to say yes to test number 4. So we are going to have to capitalize the lease. So that completes part 1, and the answer to part 1 is it will be a capital lease. So now we're ready to do the journal entries. Now on the leasee side of things, we're signing the contract on the first day of 2012. Since this is a capital lease, we're going to treat this almost as if it's our asset. So it's equipment, but since we don't own it, it is a debit to leased equipment. And at the same time, we are obligated to make these lease payments. So that's a liability. In fact, it is a lease liability. And we will record this at what? At the current present value, which was right here, $64,427.50, or if we round to the dollar, $64,428. So that will be the journal entry on our side of things because we are the leasee. But they also want us to do on part 3 the journal entry for the leaseor. Now from their point of view, this is going to be money that they're going to be receiving from us. So it's not a lease liability, it's a lease receivable. And since you can't have the same asset recorded on 2 sets of books, then we want to actually remove the leased equipment from their books. But on their side, they're going to record it at the full value of the leased equipment, which is the fair market value of $70,000. So that completes the journal entry for the leaseor. And that completes this example on leases.